Hi and welcome to Penser Bank and our analyst presentation of Bergman Beving. My name is Markus Almerud and I'm an analyst here at the bank. So Bergman Beving, B, acquires and develops leading companies with niche products and brands in industrial and construction sectors. Products involve screws, protection wear, tools and consumables. 68% of sales are proprietary brands, with the balance being third-party products being sold through its distribution businesses. The investment case, in short, is that the strategic U-turn it did 5 years ago has started and will continue to have an impact. A lot of this growth is going to come from acquisitions, and as the drivers become more similar to the compounders where the company have its roots, we would expect for multiples between B and the peer group to converge. We see an upside of around 50% in the share. So we're speaking today to give an update after its Q2 results during the second half of October. I will touch upon volumes and the business cycle, the margin development, the cash flows and acquisitions. So starting with the volumes. So B posted negative organic growth in the quarter, but it was because of two things. Firstly, the company keeps phasing out unprofitable volumes to raise the margins. And secondly, there was an IT attack on one of its distribution partners, which alone shaved off 3 percentage points to growth. The contribution from M&A accelerated though, and this is positive, and we expect for this trend to continue. Now the margin has steadily expanded over the past couple of years as focus has increased, as unprofitable business have been phased out, and as accretive acquisitions have been made. Adjusting for the extra cost related to the IT attack, the margin in the second quarter was actually the highest ever. Looking at acquisitions, they continue to be a core part of its strategy, and it keeps building pipeline. Earlier this year, they acquired Polartherm, which is a leading provider of mobile heating units, and this was the largest acquisition they've ever made, at least since the change of strategy. Finally, a couple of words on the cash flows. The cash flows are very good, and the market is not appreciating the underlying cash flow generation in our view. So Bergman Beving is trading at mid to high teens free cash flow yield and 4% dividend yield. In summary, volumes are negative, but only because of an IT attack and phasing out of unprofitable volumes. Adjusted margins are at all-time high and rising. The contribution from acquisitions is accelerating, and cash flows are very good, very good. The market does not give them credit for this, but we think it will. Thank you.